All right. Let's see. Good morning. This is Vince Lanci, and we have a lot to talk about and not a lot of time to talk about it. Things that we're not talking about. How's that for anticlimactic? All right. We're not going to talk about what you see on your screen right now, but I have done the research, and this is all part and parcel of us creating better and more content for our subscribers. Uh, this would not be how to do it. Uh, that's all part of my research. The World Gold Council put out its market outlook for 2019 gold bugs. You can either listen to it or fade it. Uh, uh, Objectivity is not their specialty, but we'll be putting this report on our own site on Opportunistic Trader. Look for that to be tweeted by, if you use Twitter to find your news, look for that at OpTrader1, as well as myself, Lanci Pictures, but it'll be checked back on our site in about an hour. Next, that will be up is we will be discussing this today, and I'll be putting this post up as well so you can read it for yourself. Um, this is about skew, and I think should be the focus for anyone who trades at all and listens to people talk about skew like they used to talk about VIX. We're going to go through. We're going to spend a lot of time on that after we go through gold because I want to explain why people don't know what the f they're talking about. There you go. Um, uh, and this is Metals Daily. This is a marketing tool that I don't care about from someone else. Okay, so why don't we start with? Why don't we start with? Okay, yesterday gold started out strong. They much of its gains late in the day. It still ended positive, up from its previous close. Now, yesterday was a much bigger day for other markets, and the reason that gold is interesting um, is its lack of movement. And there is no usual anymore. There is no normal anymore. But suffice to say, for the stock market to do what it did and gold not to react either by A, idiots buying it as a safe haven, and by idiots, I mean people that aren't me, or B, people selling it to cover margin calls. The fact that it did nothing was probably a surprise to many, but not to me. And it's not because I'm such a genius. It's because I've noticed, as few others have, but people are starting to notice it, the increasing peg between the yuan and gold. Energy traders should pay attention to that as well. Not necessarily gold per se, but uh, China is now in a situation. I can't emphasize this enough. There's going to be a relinking with oil and gold. I don't know how and I don't know when, but it goes like this. China buys stuff. All right, this is for the oil people out there that are listening, because if you trade gold, you trade oil. To put it this way, if you trade gold, you have to trade oil because gold doesn't move enough. China buys stuff buys natural resources and puts out finished goods, broadly speaking. So when they buy oil from Russia, which let's say they buy oil from Russia and Iran, let's say those are their only two suppliers. What they have done in the past, and then we'll add Venezuela to that as well. Uh, Thank you, Tracy. It's actually interesting. Um, Iran, there goes oil. There you go. Okay, so basically, if I start reading that, I'll stop doing my own work there. But anyway, basically, China wants, as does the world, the IMF wants it too, to decrease the importance of the dollar as a reserve currency. And what this trade war has done is it has exacerbated or forced to a head the problem, made the crisis more aware. So either you're choosing sides now. Either buying, you are buying the U.S. In terms of your trade partner, or you're more aggressively getting out of your dollars. So if you're China and you want to buy oil, and Russia's saying, just taking it to extreme, we don't want to deal in dollars anymore. China says we want to deal, well, then deal in yuan, and Russia says, well, we're not going to do that unless you have something substantial behind it, something substantive. And that's one of the reasons China has bought gold, not because they're going to a gold standard, which they could if they wanted to, but because they need a bridge off of the dollar and onto their own currency. And it's a fact that China and Russia have done billion-dollar oil deals backed by yuan using blockchain with gold calls involved. But moving forward, uh, gold in context of the market yesterday. Actually, this is important because if you see yesterday's chart was kind of was a doji and not necessarily something that people would be encouraged by. And ignoring my own rule, I got out of my long, and that's something not really smart to do. Excuse me, but I did it because I violated my own rule to begin with. And one of the things you don't want to do when you when you ignore your discipline, is forget the fact that once you've ignored it once, you can keep doing that. So I don't want to sound too scatterbrained. So why don't we narrow the topic here? You can read this on your own. You'll see what I'm talking about. Gold in context. Global equities are where they are right now. Looks like a little bit of a dead cat bounce in some areas. Today's data, U.S. and Canadian jobs data, and Mexico CPI are the remaining data highlights of the week. Should note that while people are talking dovish in the U.S., and I don't think that'll happen, people are talking more dovish in Canada. I don't know how that manifests itself, but they're supposed to be raising rates there, but who knows? Maybe they won't. You can read through that as well. Okay, today on the VBS system, before we go to the technicals, you have a 240-minute chart there. Now, when we had that green long candle higher about 20 hours ago, we did not get a signal to buy uh, because the bottom line did not widen out. And consequently, we came back in. So that's kind of cool. We didn't get sucked into that. But since then, the market has crawled higher. Now, in my experience, ignoring the Bollinger Bands, when you see something like that, that's a retest up there. And either there are stops up there or there's a brick of selling. I'm kind of worried there's a brick of selling, but that's intuitive and it's not system based. The point is, we could have a breakout on the 240-minute today. It is a Friday. Fridays tend to be bullish or counter trend of the week. We say bullish in gold because gold's had been going down forever, but they are counter trend for the week, in my opinion. As people that have made money Monday to Thursday, this was a shortened week with Wednesday off. They tend to take profits on a Friday, especially algos in stocks. The second chart there is the gold market against yuan, and actually why I got out of my longs last night for basically a scratch. I think I lost $1. I don't have the picture of the snapshot of the screen, but I closed my gold long at about 224 last night. Non-farm payrolls are in 22 minutes, by the way, guys. And I'm looking for a reentry on a strong close on a Friday because we do have a weekly signal, but I got out because I was a chicken of my own ideas. Here's the technicals. 1250 would be your upside and 1242 would be your downside. Pay close attention when he puts things in italics. That was just a guitar. Sorry about that. Pay close attention when he puts things into italics. Uh, uh, Recommendations aren't being made here, but usually when that happens, there's a trend line that's becoming more important. All right, for listeners, option skew. We'll talk about the other stuff later, knowing rules, but I want to focus on the option skew, and I'll make this as big as I can for my screen. You will hear people, as you used to hear people, discussing stocks that, oh, we're running a big, let's say we're talking about a call skew. Okay, let's say we're talking about like natural gas. All right. Oh, the market is trading at the highest call skew in a long time, and the market is near the highs. That's bullish. No, wrong. It's nothing. I'll give an example of why it's bullish, and I'll give an example of why it's bearish, and I'll give an example of why it's agnostic. I'll give you the reason, the real reason why it's agnostic. This is something I had to study when unfortunately being stuck with designing option models at Cooper Neff. And that was stochastic processes tied to skew. But without getting too wonky, let's just give you real examples. If a market is making new highs, like gold has, let's say, and I want to take this, and everybody who trades anything that pays attention to skew should take note of this. When a market makes highs or is near highs, and you see skew blow out in the direction that the market is going, could it be bullish? Yes, it could be people that are short the market inherently buying hedges, no different than when people freak out and buy puts as the stock market drops. It could also be, and frequently is in gold, and I'll explain why later, that it's kind of like a stochastic, where the market is making new highs, but the gold contract is too big, or we don't have enough money to put into it, and all the big players are in. So we need exposure to gold, but we don't really have the money to buy futures, so we buy calls. So when skew goes heavily towards the calls in gold, it's not necessarily bullish. It's 50-50. It could be bearish. Um, it could be people running out of money to buy gold, and so they're buying options instead. Could it be bullish? Yes, it could. But if you remember, if you recall in recent conversations about oil, frequently calls would be bid at the top of the market in oil, as hedge funds like Philip Brothers. Well, they weren't a hedge fund, but they operated as one. Andy Hall would frequently buy calls near the top of a move so he could hedge and get some liquidity to sell his futures. So I do not want you to look at this as bullish, but I do want you to look at it in context of gold, as gold is a market that used to be a heavily call skewed market, and that's because the market was dominated by speculators, not producers, and that's because producers were dumb. Producers are still dumb by and large. They don't hedge. The gold market should be dominated by producers. It should be a put skew market where they're buying puts and selling calls. But it wasn't forever. Anybody who's a subscriber who was on the floor with me knows that gold was a market where people would not buy futures, they'd buy calls. So producers didn't hedge, and they were Texas hedgers, so to speak. What ended up happening was GLD was listed. Excuse me, that's my coffee. And GLD was an equity product dominated by people that traded much smarter. And in the equity product on GLD, if you were a hedge fund manager and you bought gold, you would buy GLD, and you would buy a put and sell a call. So you had a heavy put skew in GLD, and you had a heavy call skew on the COMEX futures. So what ended up happening is the tail wagged the dog, and the skew in gold went away, and it went to a put skew. Now we are back to a slight call skew. Log normal distributions matter. This is not really a big skew when you're looking at a 50 delta fence, half of vol. If you look at oil, it's much bigger on the put side. So what I'm getting at here is, without getting into the nitty gritty of options, is a market skew indicates the dominant player in the market. And by that, I mean, if you're talking about commodities, if it's a put skew, a producer dominates it. If doesn't mean it's bearish or bullish. If it's a call skew, that means an end user dominates it. So typically for oil guys, you'll see this. Oil is dominated by producers who hedge by buying puts and selling calls. Gasoline and heating oil is a product that's dominated by end users who buy calls and sell puts. That means heating oil producers, let's say a mom and pop heating oil producer, will buy a call and sell a put because he has a contract to sell heating oil to Joe Smith around the corner, but he hasn't made the heating oil yet. So heating oil producers are short heating oil, and they have to protect themselves until they make their heating oil. They're long oil, and so they would hedge the other way because they buy oil. Anyway, moving on. Ignoring your rules. This is a pure buy gold weekly signal that's going to end today, probably bullish. At the very bottom, you see a rectangle showing that volatility was less than 50%, 5 to 20 day. And then you have a widening of the Bollinger Bands. These are 2 out of 3 indicators I use, and the market is up. Now, I bought at 12.45. It's marked in percents. Sorry about that. That's because I'm doing a test on an algorithm for an RTM model for the yuan, which you'll see that later on. But basically, you should be, if you were to use this model as I do, you would buy the close. Let's hope it's not $50 higher, and you would stop yourself out at your new stop would be, right now the stop is 12.34 and change. Your new stop next week would be the upper Bollinger Band here, which you don't know because it's still moving around. All right, so I ignored my rule and I got in early before the week was over. But I had a way to do that. That is, you average in, meaning you buy some now and then you buy some as time goes on, working on probabilities. Ignoring my rules 2.0, I looked at this and I said, with all this trade stuff going on, stocks were down, the dollar really didn't budge that much. And I said to myself, actually, someone planted a seed. It was like, what's that movie with uh, Leonardo DiCaprio, Inception? Someone planted a seed in my head, and that seed was, if I was China and I really wanted to screw over the US right now, I would debase the yuan. Now, I am a follower of, a believer of the increased tie between the yuan and gold. And you can see that here. Now, I'm not proposing that the red line is something that has to be converged with. What I am saying is pay attention to the slope. Uh, uh, a channel trade would be better if I did this. You can move the red line up or down any way you want to make things match. But when I looked at this, I said, despite my bull signal, I said, well, either yuan has to rally or gold has to sell off at least a bit. And yesterday's close scared me, so I got out last night with the idea being that, my God, if China really did want to mess with U.S. investors, they would do that. And then after I got out, I realized that was a stupid reason to do it because China wants to do a deal so they can break it later on. Um, that's pretty much it. Some of the data here is provided by Mark Chandler. I encourage you to follow him online. We have a seminar, webinar coming up. Sorry, it's cold out. I've been playing a little bit of the a little bit of the Who "Summertime Blues" to uh, make myself happy here, warm here. But I do want to put up a couple other posts that we're putting up today. We have 4 great reports, and I'm looking at the wrong thing. Uh, 4 great reports that I just uploaded uh, uh, from an analyst. Uh, Now, when I say great, it doesn't mean they're tremendously reliable. I'm not recommending. They're great because they're really not tied to any sell side bank. So here's the S&P Global ratings. I like this informatively, although I don't definitely buy the hype. Uh, I do like to read these things. ANZ Bank from Montreal. I like these guys. ANZ Research. This is basically about macro themes for next year. It's a monthly report. I also have to put up. This is about China. This is Credit Agricole, which I really do like. Credit Agricole. Uh, uh, for years, I've liked their stuff because they're brokers primarily. They make their money on brokerage, but they don't have any real bias that they need to. But it's worth reading. And if you're trying to educate yourself on macro markets and why they do things, I recommend reading it. I spent years reading Barron's on Saturday out of college just to educate myself, and I would tape it to my walls. But I used to walk to school in snow, uh, uphill both ways. I take a look at this Whale Wisdom Hedge Fund Ownership Report Q3 2018. The name is why I looked at it. Whale Wisdom is kind of funny. I think what they're talking about is that the bigger hedge funds are whales and what they're doing, and it talks about what uh, different funds, different types of funds are doing. And I like this a lot. We'll be putting these up during the day in PDF. We'll also be putting our reports in I wouldn't call it partnership, but in conjunction with the relationship with Zero Hedge that I've had for years. We'll be putting our overnight report there as well. So look for these reports today. And I want to finish. It's 8:19. Uh, China talks are going well. That's from the chat room. President Trump tweets China talks are going very well. The recent arrest of, I can't even say it, I think it's a phone company, Huawei's CFO in Canada, raised questions about the durability of the US China trade truce. That's a good point, and that's for subscribers. I'm sharing that with you. Um, why don't we go back to, no, why don't we go back to uh, the post? All right. All right. So why don't you go to live markets while we're talking here? All right, we're going to end on a, a joke. All right. Now, you may or may not know this, but once upon a time, and it's still true, it's 8:20. I don't have much time to do this. Actually, we'll do it another time. Let's just put it this way. Historically, brokers and traders have an antagonistic relationship. And uh, they would have to keep each other honest. So brokers, pretty much, traders thought brokers were dumb, and they were executing orders like grocery clerks, and brokers thought traders were arrogant and blamed other people for their mistakes, and both were right at their worst. Anyway, what I want you to focus on today in gold, just the message today in gold is this: the technicals are very important today. Uh, I have a weekly breakout, and weekly breakouts that would say buy the close today could end up with stops going off above 1250. I think there are stops right above the market here. In fact, I know there are stops right above the market here. CTAs have their stops between here, 1250, I should say, and 1288. And CTAs are the new retail in the market. They're aggregated retail, and they've been short and profitable for some time. Um, so I want you to note that if we trigger stops at 1250 and go above it, and you're long, and then we come back through 1250 underneath, be careful. That could be the stops being met with the big money selling, whether it be commercials, whether it be bullion banks, or whether it be hedge funds that are looking for an exit. This could be a short-term top for the market. I do like gold on a macro basis, as we bought lower, but as a swing trading product, I admit it's been a little bit choppy lately. I like the signal I got this week. I just hope that if it gets above 1250, it sustains itself above 1250. Then I'd be super bullish. Always be aware of anyone who's super. But it's 8:21, and I would like you to stay with us because this is what's coming up next. All right. Here's the detailed overnight report for subscribers and for people on our list for December 7th, 8 o'clock. You just had the gold fix with me, the 8:30 roadmap. Larry Benedict, Michael Aronovitz, and myself will recap overnight market activity, and you can keep reading. Tony Greer comes in at Greer. I don't have a list from TG Macro discussing equity and macro markets. Edward Meir comes in at 11 o'clock. This happens every day, folks. These are professionals. They're not employees of the firm. These are people with, decades of market wisdom. They're not selling you on ideas and putting little ribbons on stuff. It's just real information. Edward Meir of Commodity Research Group discussing global macro landscape. Mark Fisher discussing energy and macro. A lot of macro stuff today. Yesterday, we had a nice tri tri-party talk between Bryn, Kelly, and I apologize. Names are, I think Phil Flynn was there, and another person discussing energy. Those are every Thursday. Ben Ryan of CRG is talking metals and discussing options trading strategies. Ben, I hope you're listening. If you're not, I'll be asking you questions. But here's the report. I want to show that to you. We have 2 more minutes, and this is the overnight recap. Right? I borrowed charts from this report. It's so good. Uh, Basically, traders and investors are awaiting what is arguably the most important U.S. economic report of the month, the Labor Department Employment Situation Report for November. So the jobs number. All right. The report is forecast up at 198,000. Recent talk with slowing economy. I want to bring something up on my own. There is no such thing as a pal put right now. There's only a knockout call, and that's an advanced option term, basically saying if we rally, that just gives Powell reason to raise rates. He's not going to, in my opinion, he's not going to do anything until the stock market goes to 2,000 or close to it. They may talk it. You may start seeing more and more people coming out jawboning it higher, but they don't care if it goes lower. They just want to slow the descent of it lower. I hope Larry is right. I hope he still thinks this way, that we get a nice strong close for the year so he can sell it next year and have some nice swing trades lower. However, he did say that we were likely have seen the high earlier in this week. And so he's right on both counts so far. The market is still, I think, slightly up. And at the same time, the high may be in for the week, as in the rest of the year. Treasury bonds are important. Pay attention to those. The flattening yield curve. We can discuss that another time. But the takeaway I want you to pay attention here is that skew means nothing. It just means people are buying calls. They could be buying calls in lieu of futures. They could be buying calls because they're bearish futures. Whatever it means, think for yourselves. We are flat the market, looking to get long on a dip above 1240. We are looking possibly at an RTM sale if the market goes between 1250, 1255, and then backs off in gold. That's our play for today. Look for specific levels in the chat room. Have a great day. This is Vince, and be well.